The two things I'd say, first of all, when you think about the bond market, bond sell-offs are actually self-correcting. And that's an important thing to think about when you're thinking about bonds, which is when you have a rise in bond yields, there's basically two elements that occurs. One, they become more attractive because the yield rises, and so your expected forward return rises, and that often brings in yield-sensitive buyers. And that's what we're seeing. Like, you're seeing TLT, which is the ETF, the long-dated Treasury ETF, has in price terms sold off as bond yields have risen. But what you've seen is a lot of buyers come in because they start to say, well, bond yields at 5%. I haven't seen that in 15 or 20 years. That's actually a pretty good opportunity to come in. There's good value in those securities. So they're coming in. Yield sensitive buyers are coming in. And I think the second thing, which is important when you're thinking about bonds, is that by their nature, the rise in bond yields creates a drag on economic activity, right? Through higher mortgage rates, higher auto rates, all those sort of borrowings that you do. And that drag on economic activity limits future borrowing, particularly by the private sector, which then creates a slowdown in the economy, which creates a bid for bonds. And so when I talk about the bond dynamic, we're basically seeing a constellation of things because bond yield rises are self-correcting. We're starting to see that sort of natural floor that's coming into the bond market. And the thing that's interesting is if you just compare that to the equity market is self-reinforcing in terms of the price action. And the equity market is only, whereas bonds are down 50% from peak, the equity market is down, not much is the short story. And so, when you think about which markets are more or less vulnerable, most of the repricing has happened in the bond market, whereas we haven't really seen a meaningful repricing in the equity market.
That is okay. That is really interesting because, if they're signaling like, look, we have higher rates, that goes out into like, I guess, broader economic activity, like not wanting to get a mortgage because of the high rates or auto loan, all of that. Okay. And so if you're a company too, like, I guess even issuing debt, you'd have to pay back at like even higher rates right now too, wouldn't you?
Right. Which is a reason why you wouldn't want, if you could do anything you possibly can do to not borrow right now, you'd basically do it, right? Because the interest rate is so elevated relative to history or income growth and things like that. So that's when I say as yields rise, it actually stops the incremental borrowing that would typically occur from the private sector.
Which would, that can be, I wonder, okay, so bond market, I suppose, could be a bit of a sign of what could come in the economy then.
That's right. Right. Naturally, there's macroeconomic linkages. I think part of the story that we've seen that's confused people is there's been a lot of increase on the short end. And the reality is that the U.S. economy very few people borrow on the short end. Basically, most corporations, they don't issue floaters anymore. Most households aren't borrowing, floating rate mortgages and things like that. They're borrowing on the longer term. And so the challenge with that is there's basically two things. One, the incremental borrowing happens on the long end. And so it's the yield on long-term bonds that actually is a much bigger driver of credit costs in the economy. And so until those rose meaningfully, we actually didn't have as much a tightening of credit costs as we had move in short-term interest rates. And then the second point, which is it also just takes some time, which is that, if you've already borrowed on a long-term basis, let's say 5 or 10 years, you're not, it doesn't matter what exactly is going on with interest rates today, but basically corporations in particular, to some extent households, there is a fundamental or baseline need to borrow over time, which can be sort of pushed off for a short period of time. But eventually, like, people move, houses for all sorts of reasons, right? Like, you get married, you get divorced, you have kids, all these sorts of normal baseline reasons why people have to move. And so, there's going to be borrowing that happens over time. And similarly, corporations have financing needs, particularly those corporations with negative cash flows have financing needs on an ongoing basis. And so, while they can delay 6 months or a year, eventually they got to come to market. And so that's why the duration of time is actually so important when you think about the effect of interest rates and elevated interest rates on the economy, because anyone can delay for 3 or 6 or 9 or 12 months, but eventually folks have to borrow.